years, and all of a sudden you've just made yourself hundreds and hundreds of millions of dollars, right? So that has been the only strategy. I think Bitcoin is now emerging as something superior to that. Bitcoin allows you to take on a strategy of acquiring scarce, desirable property, but now you can acquire it in units of $20 at a time or $200 at a time, and so it's an egalitarian strategy for wealth creation or wealth preservation. The big catalyst here, I mean, the first one was, Satoshi's creation of Bitcoin, right? Put a big star on the map nearly 15 years ago. Coming up in a few weeks is the anniversary of the white paper. The second big milestone was the end of the block size wars, when Bitcoin was established, as this censorship-resistant network that's resistant to the meddling of corporate interests and others, and we sorted out what's the dominant chain, and a lot of theory and a lot of values got cemented in the block size wars. I think the third milestone is the entrance of is actually COVID and the entrance of corporations, right? COVID catalyzed corporations to look at Bitcoin. So without COVID, MicroStrategy doesn't do Bitcoin. And without MicroStrategy doing Bitcoin, probably the next set of companies don't do it. You don't get 24 Bitcoin holders, and then you don't get the accountants interested, and then you don't get fair value accounting, and then you don't get the clamor for the ETFs and the spot ETFs. So that was the next milestone. Then after that, the spot ETF will be the next really big milestone, because it'll be a high bandwidth institutional on-ramp for tens of billions or hundreds of billions of dollars of capital. And so that's really key. So, and then after that, the embrace of the traditional banking networks, right? The Deutsche Banks, the Santanders, other banks starting to custody Bitcoin and provide banking services. So all of those things coming together, they actually deliver digital scarcity as a fungible liquid asset to all classes of investors. Now, if we consider them, the retail investors will benefit. They've been engaged, but there'll be an order of magnitude increase in retail participation with spot ETFs because just about every working person has a 401k that's wired through conventional Wall Street money managers, and so you'll start to see the flow of those kind of funds enabled by the Fidelities and the BlackRocks of the world, and that will increase retail participation by an order of magnitude. I think institutional participation will also increase by orders of magnitude because the spot ETF. They really can't engage in the current structure because all the institutional money managers have accounting systems, compliance systems, control systems, risk management systems that are all trading systems and collateral systems that have all been built over 30 years. And in that system, they can punch a button and buy $1 million of Apple stock, or $1 million of a gold ETF, or $1 million worth of the S&P index, or $1 million of bonds. And they can just do it instantly, and everything is accounted for. And if they make money, they get compensated. And if they lose money, right, they get criticized. And at the end of the year, their taxes get paid that way. And if they want to buy $100 million, their bank, like JP Morgan, fronts them the money, and so that entire system, which is a combination of technical functionality and accounting functionality and risk management functionality and financing functionality, all of that gets activated by the ETFs. So they will be able to participate, and we will start to see an evolution in portfolio thinking. It's pretty clear that the 60-40 portfolio is a thing of the 20th century, and people are starting to question it. And so now I think you'll start to see portfolio models that might vary if it becomes, when there's digital gold and people say, if you like gold, buy 50% real gold, 50% Bitcoin, right? Your portfolio models break and lots of capital flows into Bitcoin. When people say the 60-40 portfolio only made sense when there were only bonds and stocks, but now there's stocks, bonds, and Bitcoin, now maybe it's 60-20-20, or it starts to be 50-30-20 or something. And so those models start to change, and the asset allocations will change with them, and that'll have an impact. And then, of course, for operating companies, we just talked about it a lot. Now it's possible to be a treasury asset, and that means that maybe instead of operating companies remitting 95% of their cash flows back to their investors, what if they actually kept half their cash flows, right? So you might see a huge amount of capital move from institutional investors and endowments back to the operating companies, right? There's no reason why Apple might at some point end up with hundreds of billions or trillions of dollars of assets on its balance sheet instead of no net assets on its balance sheet. There'll be lots of interesting debates over it, but the point is now it's not even possible, and in the future it will be possible. I think that Bitcoin will creep into sovereign balance sheets, both sovereign wealth funds as well as sovereign nations. It'll start with the smaller ones that are more innovative as a small percentage, and over time it will grow. It's not going to replace the currency that's used as currency or the sovereign debt used as the lowest risk asset. It's going to replace real estate and equity and property and all the other things that people buy. It's like, if you're the sovereign wealth fund of Norway and you're comfortable holding $100 billion of S&P equities, you could allocate half of that to Bitcoin instead. And you might very well convince yourself that that's diversification and that's less risky. So Bitcoin does serves this new emerging role, right, which is as a diversifier. And I think that at this point it's probably worthwhile for us to come back to how does Bitcoin compare to sovereign debt as an investment asset. And if we think about that, sovereign debt is low risk money. It's a monetary investment. I've got $100 million in cash flow, and I have to hold it somehow. So I've decided I'll invest 90 million of it in treasury bills with a duration from 3 months to 12 months. Low duration risk, low credit risk. I'm getting some yield. I'm holding it as a currency substitute of sort. What's the negative, the positive, and how do I compare it to Bitcoin? Well, Bitcoin is a non-sovereign store of value bearer asset that does not generate yield. Treasuries are a sovereign asset, sort of a bearer asset for the most people think of it that way, although it's not quite. But it has counterparty risk in a couple of ways. It has counterparty risk over the long term because there's inflation of the unit. It's currency derivative. It doesn't have counterparty risk if it's the reserve currency of the world, but every other piece of sovereign debt has counterparty risk because Argentine debt instruments get defaulted on. Nigeria might default on their debt. So most nations other than the United States could default on their debt, and they could do a soft default, or they always have this option of a subtle default, which is I'm just going to print twice as much of this stuff, and I'll pay you off in the currency unit, but I'll devalue the currency unit. So I'll devalue my currency to pay you off, and maybe I'll devalue you in the near term, or maybe I'll devalue you, like if I basically issue a bunch of 10-year bonds in the euro, and in 10 years I told you that there's going to be 10 times as many euros in circulation. Well, then you don't want to be holding the 30-year euro bonds. You might not be devalued in the next 12 months, but you're getting devalued in 10 to 20 years. And so the 30-year euro bonds are going to mature worthless, right? So sovereign debt has a lot of that kind of duration counterparty risk. And with every country, every kind of sovereign debt has duration counterparty risk because they can change their monetary policy. And then all of the weaker countries, the second, third tier countries, have credit risk as counterparty risk. And even if you have no duration, if you have 90-day sovereign debt from the United States, you still have sanction counterparty risk. If you're on the wrong side of the nation in a war, then you're going to find yourself sanctioned, and those instruments are going to be canceled. So they are securities. They're securities issued by a government, right? A nation state, and they're senior to, of course, a whole class of other credit securities like the municipal bonds that are issued by cities like New York or states, or of course corporate bonds and other kinds of bonds. Bitcoin is advantaged to those sovereign securities in a variety of ways. One is there's no counterparty, so you don't have a council that sets monetary policy. That's a big advantage. The second is there's no nation state behind it. So that's a big advantage. The third is it is a asset you can self-custody. It really isn't practical for a corporation to custody $1 billion worth of government